Okay, now we're going to talk about selling a fixed asset and how that works. So page 442 of the chapter. So we have purchased equipment at a cost of $10,000. That's my initial cost. It had a useful life of 10 years, and it had no residual value. So the annual depreciation under the straight line method would be cost salvage life. Be $1,000 per year would be my annual depreciation. So it says that it was sold for cash in the 8th year of its use. The balance and accumulated depreciation for December 31st was 7,000. So the balance at the end of the prior year and accumulated depreciation was 7,000, which makes sense because we had it for 7 years, and we've recorded $1,000 of depreciation every year for 7 years. So step one, when I'm disposing of a fixed asset, step one is to update my depreciation. So let's say I do only write my depreciation entries once a year. That means that if I'm selling it in the middle of the year, I need to update my depreciation to the current time frame. So in this case, that would mean I need to update it by several years. I'm sorry, not by several years, by several months. So if I sold it, it says that on October 12th of the 8th year, they decided to sell it. So October 12th, we're gonna do the whole months rather than worry about the 12 days. So they owned it and operated it for January, February, March, April, May, June, July, August, September. And they didn't do it for all October, so they had 9 months. So my depreciation for the final year, is 9/12 of an annual depreciation. So I'm going to equals 1,000 times 9 divided by 12. So $750. So step one is update my depreciation. So I'm going to do depreciation expense. Depreciation expense for 750, and I'm going to credit accumulated depreciation for 750. All right, so there's my step one. Step two, and it kind of just makes this easier if you can do it, is to find the book value. Now remember, book value, I'll hold this down a couple lines. Book value is cost minus accumulated depreciation, the total accumulated depreciation. So the total accumulated depreciation, we have the cost, which is 10,000. The total accumulated depreciation, we had 7,000 to begin with, and I just added 750 to it. So 7,000 plus 750. So my book value for this asset is 2,250. And why does this matter? Well, why this matters is because if I sell my asset for more than this, that means that I actually gained on that sale. If I sell it for less than this, then I had a loss on the sale. If I sell it for exactly that amount of cash, then I have no gain or loss. So the three things that need to happen, the three things that have to happen in every sale, because I'm selling the asset, is I have to record the cash that I received, and I have to get rid of the asset from my books. And what that means is I need to get rid not of only the asset, but any of the contra asset that has to do with it. So I'm going to get rid of any accumulated depreciation as well as the equipment itself. So the first example, they said that we sold the asset for $2,250. So that is my cash, my accumulated depreciation. I just figured that out. I need to get rid of it. I debit accumulated depreciation for $7,750. The equipment would have been on my books at its initial cost of $10,000. So 10,000, and I balance these two total of 10,000. I have no gain or loss because I sold it for exactly book value. Now, what happens if I sell the asset for $1,250? Okay, so these three things, the accounts stay the same. Still going to have cash. I'm still going to have accumulated depreciation. As a matter of fact, not only the accounts stay the same, the accumulated depreciation and the equipment stay the same because they have to, because I need to get rid of this asset from my books. So because I'm getting rid of it from my books, those numbers won't change no matter what I sell it for, whether I even just dispose of it, it's going to stay the same either way. How much cash I receive in this case, 1,250. Now I don't balance, which is an issue. I got 9,000 total in the debit column and 10,000 in the credit column. So this is going to be, since I sold it for under my book value, this is loss on sale of the fixed asset, and it's going to be the $1,000 difference. And that's just, this adds up to 9,000. It's also, you could also figure it out by taking the difference between what I sold it for and the book value, and that'll be the loss on the sale of fixed asset. Okay, so now what happens if I sell that asset for $2,800, sold for $2,800? Well, again, first three accounts are going to be the same. Still have to get rid of the asset, still receiving cash. Cash is going to be $2,800 this time. Accumulated depreciation, exactly what it was before. And oops, sorry about that. Accumulated depreciation, exactly what it was before, and equipment credited for exactly what it was before. But now I'm at a balance the other direction. I got $10,550 in debits and only $10,000 in credits. So this is going to be a gain on sale of fixed assets for $550. So that is selling a fixed asset. If I were to just dispose of the fixed asset, by the way, if I were just to dispose of it, that's really on the prior page, dispose of fixed asset, and everything else was the same, I wouldn't have cash anymore, but I would have my accumulated depreciation. I would have my equipment like I always have. And then since I received no money to balance this out, it'd be a loss on the sale, loss on disposal, really, if I just threw it away of equipment. And it would equal the book value, because that's what I have it on my books as being valued at, and I'm just throwing it in the trash, which means I'm losing that value. So that is a disposal of fixed assets, and I think, and selling of fixed assets, and I think that's the last thing I'm going to cover in chapter 9.